Welcome back, YouTube investors. Today, we embark on a deep dive into the railroad sector, analyzing four of the most influential players in North America: Canadian National Railway, Canadian Pacific Kansas City Limited, CSX Corporation, and Union Pacific Corporation. These industry giants serve as the backbone of goods transportation across the continent, ensuring the efficient movement of commodities, consumer products, and industrial materials. However, the key question remains: are these companies good investments at their current valuations and tariff uncertainty? To answer this, we will explore their financial metrics, profitability, dividend sustainability, and overall market performance. One of the fundamental ways to assess a company's valuation is through the price-to-earnings ratio, which reflects how much investors are willing to pay for each dollar of earnings. A lower P/E ratio can indicate an undervalued company or one with lower growth expectations, while a higher P/E ratio often suggests a premium valuation due to anticipated growth. Canadian National Railway currently trades at a P/E ratio of 20.05, which is below its 5-year average of 23.90, suggesting that it may be undervalued relative to its historical range. Moreover, its forward P/E ratio of 15.74 suggests that investors expect earnings growth at a more reasonable price. Canadian Pacific Kansas City, on the other hand, has the highest P/E ratio at 28.58, which surpasses its 5-year average of 26.59. This suggests that the stock is currently trading at a premium compared to its historical valuation. However, its forward P/E ratio of 19.24 implies that the market anticipates a more moderate valuation as earnings grow in the future. Meanwhile, CSX Corporation is trading at a P/E ratio of 16.77, which is lower than its 5-year average of 19.40, indicating a possible undervaluation. With a forward P/E of 14.31, the company appears to be positioned for stable earnings growth. Finally, Union Pacific has a P/E ratio of 21.42, which aligns closely with its 5-year average of 22.42, suggesting that it is fairly valued. Its forward P/E of 17.76 indicates a reasonable expectation for continued earnings expansion. To complement the P/E analysis, we also consider the price-to-earnings growth ratio, which factors in projected earnings growth relative to valuation. A lower P/G ratio often indicates a stock that is fairly priced in relation to its expected growth. CNI's P/G ratio of 1.64 suggests a reasonable valuation given its expected growth. CP's P/G ratio of 1.86 indicates a slightly higher valuation relative to its projected earnings growth. CSX's P/G ratio of 2.24 suggests that the stock may be somewhat overvalued given its growth trajectory. While UNP's P/G ratio of 2.10 similarly points to a relatively high valuation based on expected earnings expansion. One of the most telling indicators of management's confidence in the company's future is insider ownership. A high percentage of shares held by executives and key stakeholders often reflects strong belief in the long-term potential of the business. Among the four companies, CNI stands out with an insider ownership of 3.25%, indicating a notable level of confidence from its leadership. Meanwhile, CP, 0.05%, CSX, 0.19%, and UNP, 0.28%, all exhibit relatively low insider ownership, which is not uncommon for large-cap transportation firms but suggests less personal financial commitment from executives. To gauge the financial health and operational efficiency of these companies, we examine return on equity, return on assets, and return on invested capital. These ratios measure how effectively a company utilizes its resources to generate profits. Union Pacific emerges as the leader in efficiency, with a return on equity of 42.6%, return on assets of 9.89%, and return on invested capital of 16.44%. These figures demonstrate the company's ability to generate significant returns on shareholder equity and invested capital. CSX follows closely, with a return on equity of 28.28%, return on assets of 8.07%, and return on invested capital of 14.27%, highlighting its strong profitability. CNI also delivers respectable results, with a return on equity of 21.72%, return on assets of 8.16%, and return on invested capital of 13.22%. In contrast, CP lags behind with a return on equity of 8.36%, return on assets of 4.42%, and return on invested capital of 7.09%, indicating comparatively lower efficiency and capital utilization. Share repurchase programs can be a powerful tool for enhancing shareholder value by reducing the number of shares outstanding, thereby increasing earnings per share. In this case, only Canadian Pacific has had an increase in the number of shares outstanding, due to a capital increase in 2022 to afford an investment without debt. However, till then it was doing buybacks like the other three companies. Union Pacific boasts the highest earnings per share of $11.09, and its projected 5-year growth rate is above the double digit, suggesting an increasing growth potential in the following years. Canadian Pacific, with an EPS of $2.63, has a higher growth projection of 15.34%. Canadian National Railway also has an EPS of $4.87, with future growth estimated at 12.2%. Finally, CSX Corporation sits at $1.79 with a future EPS growth of 7.47% compound annual growth rate. Earnings growth and free cash flow are also critical indicators of financial health. Companies with consistent growth in these areas tend to have sustainable business models. CNI has had a consistent EPS growth over the last decade with a modest 6% to 7% compound annual growth rate. Here, CSX Corporation seems to be the one who has the higher growth of both free cash flow and earnings per share double-digit growth. Notably, all 4 companies' free cash flow per share seems to be increasing highly during the next 12 months, despite the U.S. president threatening to raise tariffs from products of Canada and Mexico. For dividend investors, yields and growth rates provide insights into income potential. A higher dividend yield is attractive for income-seeking investors, while strong dividend growth suggests a company's ability to increase payouts over time. CNI has the highest initial dividend yield with a value of 2.62%, growing at 10.19%, and also the highest payout ratio. CP's yield is lower at 0.74% and also has grown at 7.54%, so less initial yield and expected growth but a more consistent dividend growth payer with less payout ratio is to be mentioned. Since 2022 the company freezes its payment to $0.19 Canadian dollar per quarter. CSX offers a 1.73% yield, growing rapidly at 9.07% with some years of impressive growth initially and now closer to 10%, making it an attractive option for dividend growth investors. Finally, Union Pacific stands out with a 2.39% yield, offering the highest growth during the last decade at 10.47%. Margins are where the magic happens, how much profit a company keeps from every dollar of sales. And guess what? Union Pacific is leading the pack with an impressive operating margin of 39.9% and a profit margin of 27.82%, showing it knows how to train travel into even sweeter profits. Not far behind, Canadian National Railway flexes its financial muscles with an operating margin of 37.1% and a profit margin of 26.09%. Meanwhile, CP and CSX are playing catch-up. CP posts an operating margin of 36.34% and a profit margin of 25.51%, while CSX delivers 36.8% and 23.95%, respectively. So, we all agree that this is an excellent industry that we should all have in our portfolio, and it has very high entry costs. Therefore, they are moat companies. Turning to revenue and earnings growth over the last 8 years, Union Pacific and CSX Corporation demonstrate flat evolution, reflected in similar total returns compared to the railroads company's ETF over the last 5 years. Canadian National, who also show flat evolution, however, had underperformed in total returns. And Canadian Pacific, that apparently has had a positive evolution, has also a similar total return. Now, let's talk about debt, because how much a company owes can make or break its future. CNI stands out again with the lowest leverage, boasting a debt/EBITDA ratio of 2.47 and a debt/FCF ratio of 6.59. That means it's managing its debt efficiently while still churning out profits. CP carries a bit more weight with a debt/EBITDA of 3.08 and debt/FCF of 9.29, still manageable but noticeably higher in free cash flow terms. CSX and UNP? They're playing in the middle division. CSX clocks in with a debt/EBITDA of 2.70 and a hefty debt/FCF of 6.97, while UNP takes the crown with 2.61 and a staggering 5.51. Meaning it relies heavily on borrowed money. But why so high ratios in free cash flow terms? That's simply huge maintenance capex that is necessary to continue the business, but also so consistent cash from operations. So these debt levels are not worrying at all. Over the past 52 weeks, all 4 companies delivered a poor and negative price return, and some of them are in their 52-week lower prices. While viewing its market caps, all of them are considered large companies with over 10 billion market caps and solid market position. Now, let's talk about the crystal ball moment, analyst expectations and fair values. Analysts have set varying price targets for these companies over the next 12 months. Canadian National Railway has a price target of $116.82, representing an upside of 19.54% from its current price of $97.70. My fair value estimates tell a very similar story. For me, CNI is close to its fair value at $100.64, That also suggests it is undervalued right now. Continuing with CP's price target is $87.95, which actually represents an upside of 16.81% from its current price of $75.29, indicating that analysts see the stock as potentially undervalued. And for me, Canadian Pacific, with a fair value of $67.88, appears currently overvalued. Now, CSX Corp has a price target of $36.31, with an upside of 20.99% from the current $30.01. And for me, with a fair value of $31.30, can indicate a little bit of undervaluation, but also a good entry point. Finally, Union Pacific's price target is $262.87, representing an upside of 10.67% from its current $237.53, with a fair value for me of $220.35, which is far from the current price and can indicate a huge overvaluation. These valuations indicate that while there is some potential for growth, investors should tread carefully and consider these stocks' current pricing relative to their intrinsic values. For example, Canadian Pacific is the only one that has railroads in the 3 countries of North America that can indicate why it is trading with premium. Each of these companies has distinct strengths and weaknesses. CNI offers strong profitability and dividend growth but has faced stagnation in revenue. CP presents higher growth potential but trades at a premium. CSX delivers strong cash flow efficiency, while UNP stands out with the highest profitability and dividend growth. Investors should weigh these factors carefully when considering an investment in the railroad sector. Let me know your thoughts in the comments, and don't forget to like, subscribe, and hit the notification bell for more financial insights. Until next time, happy investing!